Hi everyone, welcome back to my channel. Today I'll be talking about how everyone can make money from the stock markets. So let's get started. As you all are aware, the interest rates have been coming down globally, and in some countries it's even negative. The pic here shows how the interest rates have been negative for the last few years in Japan as well as Europe. And in the US, the Fed recently cut the interest rates to zero. India has been following the same trajectory as interest rates are coming down rapidly from 6% in April 2019 to 4.4% after the recent rate cut by the RBI. The fixed deposits hardly fetch you 6%, and the real estate has been in a bad shape as well. Indians have this undying love for the yellow metal. Although gold has outperformed in the last few months, its long-term returns are quite less compared to the stock market returns. So the most attractive investment option right now is the stock markets. After the recent correction in the last few months due to the pandemic, the stock markets offer the most attractive investment option for the long term. So how can one with very little or no knowledge invest in stock markets? The answer is through mutual funds or ETFs. Now I'll explain what mutual funds or ETFs mean. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities like stocks, bonds, etc. A mutual fund's portfolio is structured and maintained to match the investment objective as per the investor's risk profile. That is, if a retired person is looking for 10% returns, then his portfolio will consist mainly of bonds and less of stocks. Whereas a person in his 20s or 30s will have all his money or most of it invested in stocks and very less exposure to bonds. Mutual funds on a long term, that is 5 to 10 years, give you an average return of 12 to 15%, almost double that of a fixed deposit. What is an ETF? ETF is nothing but exchange traded fund. Just like a mutual fund, an ETF is also created from the concept of pooled fund investing. The Nifty ETF tracks the Nifty. That means as the Nifty goes higher, so does your investment, and vice versa. The Nifty 50 has given a compounded annual growth of around 12% since inception. That's still much higher than a bank FD. The main attraction of ETFs are the expense ratio. As mutual funds charge higher management cost, it's relatively less or almost nil in an ETF. And ETFs also offer you tax advantages. So by investing in a mutual fund or an ETF, even a common man with no knowledge about stock markets earn higher interest than a bank FD or an RD. That's all for this video. If you have any queries, please comment in the comment box and I shall reply to them. I will be back soon with a new video explaining the basics of stock market.